What's up, tribe? This is Justin, Elevate Credit. Today is day 136. 3 different types of real estate valuation methods. So, thank you guys for following this journey from day 0 to reuniting my wife and my son here in the U.S. We're talking credit repair, business funding, real estate, investing, just taking that next step to achieve that next level of life. So, 3 different types of real estate valuations. What you have to realize is that not all types of real estate are valued the same. In fact, there are a handful of different ways. The first way is called the cost method. This is typically what an insurance company will use to value a piece of real estate, say if it burns down. And they will use this cost method to apply a number to rebuilding the structure. The second type of valuation method is called the comparable sales method, and this one is very typical. It's probably the most common type of valuation method. There is typically for land and single family residence, 1 up to 4, because they qualify for conventional types of financing. And the way that it works is that you would find a comparable property to the one that you are trying to value based on square feet, bedrooms, bathrooms, finishes, location. These are all very important types of traits, and you would find the comparable sales, a property that's sold with those exact same traits that of your prospect property, and attach a value to it based on so many dollars per square feet. You can calculate the value of that. The third type of valuation is called the income approach valuation method, and this has less to do with comparable sales but more to do based on what kind of income the property can kick out. And this has to do with you're gonna have to get a profit and loss from the owner. You're gonna have to verify bank deposits, tax returns. You're gonna create some type of profit and loss. You want to know what are the rents that the property pulls in, what are the expenses against the property, excluding debt service. We're just talking tax, insurance, electricity, water, sewer, maintenance, management, all of these different types of expenses. Then you're going to annualize that and come up with what's called a net operating income. And your net operating income is divided by your cap rate, and then that will give you the value of that income producing property. I prefer the income approach because it gives a true value to the type of property, just gives a true value to the property that you're looking at, in my opinion. So those are the 3 ways to value real estate. Of course, it just depends. Income approach is for 4 plus. Comparable sales 1 to 4, including land. Cost is for insurance companies. So thank you guys for following. Remember to hit that like button, smash that subscribe button, leave a comment. Check out the link. We have ebooks, e-courses, everything and anything you need to fix your own credit and get funding. If you're interested in working with us one-on-one, we can do that as well. Last but not least, to my son Josiah, son, you are blessed, you are anointed. Remember to use credit responsibly to your success. Salud.